What's going on, everybody, and welcome back to Exploring Investments with Justin. And in today's video, I'm going to be covering 5 beginner mistakes that investors make. Now, a lot of these mistakes I did make myself, and I want to make sure that you guys don't make the same mistakes I did. So if you appreciate this video, be sure to let me know in the comments section. Let me know if there's any mistakes that you guys made or mistakes that I didn't cover. And be sure to let other people in the community know about them so we can all learn from each other's experiences. And like I said, if you appreciate the video, be sure to hit the like and subscribe button because it really does help out the YouTube algorithm and help the YouTube channel reach more people. So with that being said, let's jump right into the 5 mistakes. So mistake number 1 that I see a lot of new investors make, especially in the market that we're in today, is trying to time in and out of stocks. Now, if you're a day trader, then obviously that's not a mistake, but if you're a long-term investor like myself, then you do not want to try and time in and out of positions because short-term moves don't matter to us. As a long-term investor, you should only be concerned about where the stock's going to be in the next 5 years. Not in the next 5 months or 5 weeks or 5 days. And I can promise you that if you try to time in and out of a stock, you will probably end up losing money because this happened to me when I first started investing. When I first started investing, one of the first stocks I bought was Tesla, and this was back when it was really volatile. So I ended up losing a lot of money in the beginning because I would buy in at $270 a share, it would drop to $250 and I'd panic and sell it. And then it'd go back up to $260 and I see myself buying back into it at a higher price than where I sold it. So if you're a long-term investor, I would recommend you not try and time in and out of stocks and just hold on to the stock for the long term because that should be, if you're a long-term investor, why you originally got into the position. And this first mistake leads me to mistake number 2, which is that you shouldn't sell when a stock goes down. Because like I said, if you're a long-term investor, it shouldn't matter if the stock goes down 5% or 10% in a day. If it does go down 10%, you should be buying more of that stock. And I think the reason a lot of new investors, including myself, sell stocks when they go down is because we're not used to being able to handle the volatility of the stock market. What I would recommend for anyone that's a new investor is that you start off with a small position and get used to seeing your account be in the red some days and be in the green other days, because this will help build up your tolerance or your risk tolerance for the future when you start playing around with thousands of dollars, maybe tens of thousands of dollars. It really depends on where you are at financially, but being able to start and learn about volatility when you only have maybe $1,000 in your portfolio will save you a lot more money than if you have $100,000 in your portfolio. So mistake number 3 is listening to other people and investing in a stock just because so-and-so said that this stock is going to go up 100% in the next year. Now, let me put this out there by saying it's not bad to listen to other people talk about a stock and to learn about a stock from other people talking about them, especially like what I do with my channel or some of the other ones like Financial Education, Ali's World of Stocks. Those are just channels that I like to watch. But when you're watching these channels and you're listening to Jeremy talk about Tesla or Planet 13, you shouldn't invest in it just because Jeremy is, or just because I am, or just because Ali is. You want to invest in it because you believe in the future of the company and that you've done your own research. So when you're listening to other people talk about stocks, if you like the stock and you like what they're talking about, then go out and do your own research and then decide whether or not this is a good company to start a position in. So as a new investor, I know a lot of people do watch other people talk about stocks, and I just want to throw this out there that there's nothing wrong with investing in the same stock, but do it because you feel like it's going to be a good return, not because Jeremy or Ale or myself say that it's a good return. So now talking about mistake number 4, this is a big one that I see a lot of new investors make. And it usually goes like this. Well, this stock used to be $50 and now it's $5. So if I buy now, it'll go back up to $50 and I'll make $1,000 on my position. And this is when you buy a stock because it's only $5 or it's only a $2 stock or it's only $10. And the way you need to look at it is the price of a stock doesn't matter when it comes to the return that you'll make on that position. Now, obviously, the price of a stock does matter because that correlates to the market cap of the company. But when it comes to your projected return or your potential return, the stock price doesn't matter. What truly does matter is how much of a position you build. So if you have 100 shares of a $10 stock, right, that would be a $1,000 investment. Now say the stock goes up 10% to $11 a share, you would have netted a $100 profit on that stock. Now the point that I want to make here is that if the stock was $1,000 and you only bought one share of this company, and say it goes up 10%, you still would have made $100. So regardless if you invest $1,000 in a $10 stock or $1,000 in a $1,000 stock, you're gonna get the same return as long as the company goes up the same percentage. So it doesn't really matter if a stock is $5 or $150. What really matters is how much you invest in the company, because the percent return you make on your money will be the same. Now, of course, there's many other mistakes, but the last one I want to talk about is the mistake of not fully committing to investing. So I know when I first started, I had the drive to build my portfolio as big as I could and as fast as I could, because I really learned what the power of compounding interest is, and that I could really grow my money a lot faster over the next 20 years if I fully committed to investing rather than putting 80% of my net worth in my savings account, where I think it gets 0.01%, so basically nothing. And what I mean by not fully committing is that maybe you throw $500 into your account and then you just leave it there and you don't add more money to your account. You know, even if you can only afford to put $25 a week or $25 a month, whatever the case be, as long as you continue to add more to your portfolio will grow a lot faster. You know, it's a lot easier to grow from $10,000 to $20,000 than it is from $0 to $10,000. So the bigger you can make your portfolio, the faster your money will grow. And the other mistake that kind of ties in with this one is not taking your profits and go buying a new Xbox or video game or jet ski, whatever the case be. Whenever you make a profit on a stock, you want to reinvest those profits into other companies, not pull it out and go buy some new toys. And that's a mistake that I definitely see investors make. And I don't want you guys to make that same mistake, because your money will grow a lot faster. So those are the 5 biggest mistakes that I see new investors make, and I've made most of those mistakes myself. So there's nothing wrong with making a mistake as long as you're learning from those mistakes and you're fixing them on the next go around. So be sure to let me know in the comment section down below if there's any mistakes that I may have left out that you guys have made, so that all of us in the community can learn from each other's mistakes. And I just want to say thank you guys for watching. Make sure to hit the like and subscribe button, because like I said, it does help out the YouTube channel a ton. And thank you guys for watching. I will catch you on the next one.